Happy Thursday, everybody. Welcome to another episode of Market Update, where we discuss leading financial and economic developments in Asia, Europe, and North America. My name is Tony. Let's jump in. And first up, at the NATO summit in The Hague on yesterday, US President Donald Trump pleasantly surprised allies by reaffirming his commitment to the military alliance, while simultaneously stoking tensions with Spain and the European Union over defense spending and trade. In a significant development, NATO members pledged to raise defense expenditure to 5% of GDP by 2035, more than doubling the current 2% benchmark. The move, seen as a major concession to Trump's long-standing demands, marks one of the largest proposed rearmament shifts in decades, and it aimed at ensuring continued US support for European security amid rising global instability. Trump, who once cast doubt on NATO's core mutual defense clause, Article 5, told his 31 allies, quote, "I'm with them all the way," end quote. The summit's joint communique emphasized, quote, "ironclad commitment to collective defense," end quote, and required members to submit annual plans showing credible paths to the 5% target. A review of progress will take place in 2029, the year Trump is due to leave office. Calling the summit's achievements tremendous, Trump stressed the need for NATO members to shoulder more of the defense burden. Quote, "It was 2% and we got it up to 5%, end quote, he said. His tone offered relief to many European leaders anxious about waning US support amid wars in Ukraine and the Middle East. However, the unity was tested when Spain's Prime Minister, Sanchez, rejected the new 5% goal, committing only to 2.1% defense spending. Trump responded furiously, calling Spain terrible and threatening punitive trade measures. Quote, "We're negotiating with Spain on a trade deal. We're going to make them pay twice as much," end quote, Trump warned, adding he was, quote, "serious," end quote, about levying new tariffs. Spain's IBEX 35 index dropped 1.5% following Trump's comments, while broader European stocks also dipped. A spokesperson for Sanchez downplayed the remarks, reaffirming Spain's NATO commitment. Germany confirmed that it would boost spending by 70% to hit 162 billion euros in 2029, outpacing France and the UK. In France, President Macron has called for the military budget to rise to between 3% and 3.5% of GDP by 2030, from about 2% now. British Prime Minister Sir Keir Starmer went beyond recent commitments to confirm that spending would increase to also hit the target. Meanwhile, tensions over trade are growing as the EU races to strike a deal with Washington before the 9th of July, when tariffs on nearly all exports to the US are set to rise to 50%. Trump has already imposed 25% tariffs on European cars and 50% on steel and aluminium, with plans to target sectors like pharmaceuticals, aircraft, and semiconductors. The EU is preparing countermeasures. It has approved tariffs on 21 billion euros of US goods and is finalizing another list covering 95 billion euros. Items on the list target politically sensitive US exports such as soybeans, poultry, and motorcycles. Despite the controversy, the NATO Secretary General praised the summit's outcome. "This is day one to mark this a reality," he said, referring to the new spending targets. The summit succeeded in keeping NATO intact for now, but it also laid bare the transactional nature of this new era and the growing fault lines between Washington and parts of Europe. Next up, we move to North America. Nvidia Corp shares soared 4.3% to a record $154.31 on Wednesday, pushing its market capitalization to an unprecedented $3.77 trillion and surpassing Microsoft to become the most valuable publicly traded company in the world. This milestone caps a remarkable rally that has seen Nvidia add nearly $1.5 trillion in value since hitting a low in April. The surge comes as investors remain bullish on Nvidia's pivotal role in powering the global artificial intelligence (AI) infrastructure boom. The chipmaker's latest earnings report exceeded expectations, highlighting robust growth and sustained demand despite US restrictions on sales to China. Nvidia's largest customers, Microsoft, Amazon, Alphabet, and Meta, continue ramping up spending on AI, collectively accounting for over 40% of Nvidia's revenue, according to data compiled by the US-based Wall Street Journal. Quote, "My confidence in Nvidia's growth is higher than it was a few months ago," end quote, said Michael Smith of Allspring Global Investments in a note to clients, adding, quote, "The AI arms race will likely continue through 2026, and Nvidia's competitive moat keeps widening," end quote. CEO Jensen Huang echoed this optimism during Nvidia's annual shareholder meeting, reaffirming that the global computing industry is only at the start of a sweeping AI infrastructure transformation. Despite massive recent gains, including a 15% rise in 2025 following a 170% surge in 2024, Nvidia still trades at a relatively attractive valuation. Its price-to-earnings growth (PEG) ratio is just 0.9, the lowest among the so-called Magnificent Seven, and well below historical averages. Wall Street remains overwhelmingly positive, with nearly 90% of analysts rating the stock a buy. Yet Nvidia is under-owned relative to other big technology giants, suggesting room for further institutional investment. Bank of America data shows Nvidia is held by 74% of long-only funds, compared with 91% for Microsoft. Industry experts believe Nvidia's pace of innovation is unmatched. Quote, even though companies like Amazon and Microsoft are building their own AI stacks, the best technology today is still Nvidia, end quote, said Daniel Newman of Futurum Group. With plans to release new chips annually, including the upcoming Vera Rubin series, and strong demand from sovereign clients like Saudi Arabia and the UAE, Nvidia looks poised to maintain its dominance in the AI era. Meanwhile, while we're still in North America, Wall Street could soon benefit from a major regulatory shift as the Federal Reserve moves to ease a key capital requirement. On yesterday, the Fed voted 5-2 to propose changes to the enhanced supplementary leverage ratio, which applies to the largest U.S. banks. The revisions would lower the capital requirement for holding companies like JP Morgan and Goldman Sachs to 3.5 to 4.5%, down from 5%, and reduce bank-level requirements from 6% to the same rate. The move is expected to free up banks to hold more U.S. treasuries and bolster their role in the $29 trillion US bond market. The proposal follows the appointment of Michelle Bowman as the Fed's new vice chair for supervision. Critics, including former Vice Chair Michael Barr and Senator Elizabeth Warren, warn the changes could endanger financial stability. Warren called the leverage rule a, quote, critical safeguard, end quote, and cited heightened risks from the ongoing trade war. Next up, we move to Asia and cryptocurrency. But just quickly, if you're getting some value from today's episode of Market Update and you have not yet subscribed, 65% of regular viewers watch but are not subscribed. Subscribing not only means that you're on top of the most up-to-date analysis as it's released, but it's also a huge help for this channel and its growth. It's just 2 clicks of the mouse, subscribing and liking, but if you want to see this channel continue to grow and help me release videos every day free and open for all, it's a huge help. Thank you so much, everybody, for the ongoing support. Next up, and finally for today, a regulatory crackdown in Singapore is prompting a significant shift in the global cryptocurrency landscape, with Hong Kong and Dubai emerging as key beneficiaries. The Monetary Authority of Singapore, MAS, has ordered unlicensed crypto exchanges serving only overseas clients to shut down or relocate by the 30th of June, unless they secure a difficult-to-obtain license. The abrupt announcement in May caught many in the industry off guard. Legal experts believe the move is part of Singapore's efforts to rehabilitate its reputation following a series of high-profile crypto collapses. Quote, Singapore took a reputational hit during the crypto winter, end quote, said Yuan Kai Lin, a partner at law firm RPC, speaking to UK-based The Financial Times, adding, quote, lots of questions were asked about MAS and whether they could have done anything to prevent these collapses, end quote. Among the firms preparing to move operations are global exchanges BitGet and Bybit, which US-based Bloomberg reports as shifting staff to Hong Kong and Dubai. According to MAS, offshore-only exchanges are harder to regulate and pose heightened money laundering risks. Quote, if their substantive regulated activity is outside of Singapore, MAS is unable to effectively supervise such persons, end quote, the regulator stated, adding that it generally avoids licensing such entities. Legal observers say that the regulator is taking steps to plug gaps in its oversight framework. Singapore's earlier laissez-faire approach saw firms like Terraform Labs and Three Arrows Capital flourish before their high-profile collapses. Now, with its financial credibility on the line, the city-state is tightening the screws. Meanwhile, Hong Kong and Dubai are positioning themselves as crypto havens. Hong Kong has introduced tax incentives for crypto trading, and Dubai, along with Abu Dhabi, is actively courting digital asset firms. Quote, Hong Kong is focusing on trading, while Singapore is focusing on wealth and investment protection, end quote, said Melvin Deng, CEO of Singapore-based QCP, adding, quote, they are playing to their own strengths. End quote. Okay, that is today's episode of Market Update. Thank you so much everybody for watching. Have a good Thursday, and I will either see you tomorrow or on Saturday.